Is it finally time to invest into the travel sector? I will analyze one of the biggest players in the sector in this video, so stay tuned. And with that, welcome back to Investing for Generations, your channel for high quality stock research for a long-term value investor. So let's go. And today I want to talk about Expedia, one of the biggest players in the travel sector. It's number 2 in the online travel agencies worldwide by revenue, just behind Booking.com. And in this video, I want to take a look how hard Expedia is hit by the pandemic situation, of course, and if there is maybe a good opportunity to buy in. And of course, the whole sector is hard hidden, and the UNWTO just said that international tourist numbers could fall 60 to 80% in 2020. And in Q1, the numbers was declined by 22% and could decline by 60 to 80% over the whole year. And of course, this affects also Expedia a lot. And so, as so many other companies out of the sector, of the travel sector at all, also the stock of Expedia was dropped in the March crash from $120 to under $50. Since then, it just recovered to a little bit over $100 right now. And the question becomes how long this situation will last. And right now we still have 6.7 million active cases worldwide and around 200 to 300,000 daily new cases, and this number is also very stable, and so there's a high uncertainty how long this will last and how long, of course, then it will also affect the travel industry. My guess is we will have this big impact in the economic at all, but especially in the travel business, at least until we have a good vaccine, and nobody really know how long this will take. You maybe know Pfizer, another company out of my portfolio, you can find analysis here up on the screen, is very far with the tests for the vaccine. So hopefully something will go on there at least to the end of the year, but nobody knows for real. And so there's a very, very high uncertainty in the market, of course. And with this said, just take a look at the financial numbers of Expedia and look how it was pre-pandemic and now in the pandemic, and then just try to decide if it's a good investment or not. And as you can see here, pre-pandemic, this was a high growing business. The revenue just grows all the time, and just lately, the last 2 quarters, it really come almost to a standstill to just 566 million revenue Q2 of 2020, which is a very high decline by over 80% to a normal quarter. And that is the point here. Before the pandemic, this was a really growing company in an overall growing market in the travel industry. Just the same we can see with the earnings per share. In the past, over the last decade, they earned money all the time, and the last 2 quarters was just horrible, and they lost a lot of money. And this just come because the bookings declined by over 90%. And so, as I said before, the business came almost to a standstill, and also now there are just some flashes that the things can come back to normal, but we are far from normal right now, and nobody knows how long this will take. And therefore, even if we had a high profitable business in the past and before the pandemic, the question becomes, how long can Expedia can stand this situation, and is there maybe also bankruptcy a possibility? And therefore just take a look at the balance sheet. And first of all, take a look at the debt equity ratio. The debt equity ratio right now is a little bit over 2. And this is because the long-term debt just rises immensely in the last 12 months to over $8.8 billion to an equity of 4.2 billion. I don't like that. Normally, I like my companies with a debt equity ratio of around 1, better under 1. Over 2, this is not a very good position. To get a better impression how big are the problems just currently, just take a look at the current ratio too. And the current ratio at 1.14 looks better. Current ratio just looks at the current assets and the current liabilities over the next 12 months. And the assets here are a little bit under 9 billion and the liabilities a little bit under 8 billion. So at least in the foreseen future of the next 12 months, I think Expedia will be not in very big trouble or not in existential trouble. But of course, with every day this situation lasts longer, it gets more difficult. We will see how this will turn out. What's a very positive point is that Expedia also have $6.7 billion in cash on hand, and so there is some flexibility, and so I think bankruptcy is not an option right now or not a problem right now. But of course, if this situation lasts for long term and maybe for another year or 2 years, at some point, also Expedia will get problems, but we are not at this point, and hopefully we will never come to this point and everything just go back to normal, even better sooner than later. And with this said, the two big players in the market, Expedia and Booking.com, could be in the long term the winners of this situation, because a lot of the smaller competitors will not survive this, and a lot of them will be bankrupt, and so the market shares of Booking.com and Expedia will just rise over the long term. And even before the pandemic, both of them, Booking.com and Expedia, just bought other competitors, smaller competitors. And so, for example, Booking bought the platform Kayak and also Agoda and OpenTable. And Expedia, on the other side, bought Votive and Travel City and Orbitz, and also the German platform Trivago. And so their market shares just rise and will rise even more when a lot of other competitors are just not there anymore after the pandemic. And so, of course, the future for both of them, even the times are very difficult right now, could be very, very bright, of course. And with this said, just take a look at the price and try to find out if at the current price Expedia could be a good investment for the long term. And therefore, as always, I try to calculate the fair value of Expedia, and therefore I just painted a very positive picture of the future. And with this calculation, and keep that in mind, I was very, very positive. I took the growth rate of the past of around 20% and a terminal growth rate of 10%, and then just put also in the discount rate, my discount rate of 12%, which just is the rate of return I expect from my investment. And then I also took the EPS for the calculation for the whole year 2019 at normal times into the year, and this was $3.77. So the influences of the pandemic is not in this calculation, it's just the imagination that we come back to the normal times pre-pandemic. When we calculate that, we come to a fair value of $124 to a current price of a little bit over $100. And so we have a margin of safety of 19, or let's say 20%, which seems nice. And under normal circumstances, I really would think about to invest in Expedia at this point. But just as I said, keep in mind this is really a positive expectation, and I don't know if this is realistic, or at least I don't know when it's realistic, because we have this high uncertainty. 19% margin of safety sounds nice, but for me at this moment it's not enough to invest in Expedia. And by the way, if you wonder and want to know more about the calculation of the fair value of a company, of the intrinsic value of a company, just check out my video here. Up is a link for my video about how to calculate the intrinsic value of a company. Just watch it and enjoy. So what's my conclusion then? My conclusion with Expedia is that, of course, under normal circumstances, we have a very profitable business in an overall growing market, and I would say this will be even the same when we came back to normal circumstances. I think there is still a high demand in the tourist sector, but right now, with this high uncertainty and really nobody knows when it come back to normal or how the world will look in the future and the travel world will look in the future, it's not the right time for me to buy in. And even the margin of safety of 20% is nice. It's not big enough for me because, in my view, the risk is much higher than the reward at this point. Maybe we just missed the big opportunity in March and April to buy into under $50, because then of course the margin of safety was around 60 to 70%, and I think at this point it was a good investment, even with a high risk of course, but with more reward than risk. But right now, with the recovery of the stock price to around $100, the risks are much higher in the investment, and so I will not touch it at this point. So that's it for today. If you liked the video, give me a big thumbs up, subscribe to my channel and ring the notification bell to never miss another video. And then we will see you next time with another analysis of a high quality stock out of my watch list. See you then, take care, bye bye.